systems. So this topic will cover the roles of the central bank because here we consider that as one of the main regulators on financial market. So last time when we mentioned about the problem of asymmetric informations, and maybe we know the main roles, one of the main roles of regulator is create a soundness financial system to make all participants have a strong confidence on financial system. And so in detail today, we discuss about the central bank. We're talking about the definition. We're talking about the roles of the central banks for the economy in general, and the role of central bank for the financial system in specific. And based on that, maybe we also discuss the main some case study referred to the central bank of different countries, including the US, European countries, Japan, and even in Vietnam, in order to compare the similarities and also the difference among those central bank. And the other part, we were concerned about the monetary policies. That is one of the instruments the central bank used to conduct or to observe or even to obtain the macros objectives, including the inflations or growth of GDP. And for this chapter or for this topic, we also have some exercise referred to the different instruments could be used by central bank in order to the open market, in interest rate or reserve requirements. And so that's we have a three main parts referred to the central bank and monetary policies. So before I tell you about these topics, I just want to show you a short videos that could be used to introduce about the central bank. Okay, so we can hear right now to understand a little bit. Central bank.
The central bank of a country is the only institution allowed to create physical currency.
Could you see my video, students?
Yes.
Okay.
In other words, coins and paper money. In today's society, however, debt is also money. The dollar you pay with when using your credit card has just as much purchasing power as a $1 bill. Therefore, as explained in the fractional reserve banking video, commercial banks create money as well by issuing loans. And since most of the money in existence is not physical, commercial banks actually create more money than central banks. Most countries have one central bank and multiple commercial banks. The central bank has a monopoly on physical money creation. They can create as much physical currency as they deem necessary. Commercial banks, however, cannot do that. Some people have to deposit money and others have to request loans. Otherwise, the money creation mechanism of a commercial bank stops working. Therefore, maintaining stability is a central bank's main goal, and it can do that by 1, managing interest rates, lowering them to stimulate economic activity, or increasing them if it thinks the economy is overheating. 2, telling banks which rules they need to follow. For example, how much money they need to keep as reserves. 3, acting as a lender of last resort and buying assets that nobody else wants during times of turbulence. For example, giving banks quick cash by buying the illiquid mortgage-backed securities they were stuck with after the Great Recession. A central bank can have other goals as well, such as full employment, but its core responsibilities revolve around maintaining the stability of a country's financial system.
Okay, so you just have a heard quickly about the introduction about the central bank, and maybe you heard some key term referred to the creations of currencies, or the reserve requirements or financial stabilities. That's also the term involved to the central bank today. And that is just very quickly. So in detail now we discuss about what is the roles of the central bank. And so we take the central bank of US, that is the good examples in the world in the way of conduct monetary policy or remains financial stability for the whole systems. And finally, we discuss monetary policy by talking different instruments could be used by central bank to obtain the macros objectives, including the inflation rate. The part ones, or the first one we just mentioned here is what is a central bank? So as you have heard from video, that central bank that is an institutions that manage currencies, money supply and interest rates of the nations. So we highlight some key term here. Okay. Central bank is an institutions. Can you see my lecture notes, students?
Yes, ma'am.
Can you hear me again, students?
Yes.
All right. So why I say that, or why I say it's, the institution is that independent, and so that's why sometimes the central bank is established in private, or that is a private companies, not state-owned company. Some of you, so when we look at the State Bank of Vietnam, and we say that is established by the governments, so that's why we're thinking that the central bank is belong to totally to the governments. But however, in the world, let's say when we discuss later about the central bank of US, that was established by the private firms, not by the government. So why is it independence? Because the objective of the government is the growth of GDP, But later you know that the objectives of the central bank is controls inflation rates, control inflations. It means keep the values of domestic currencies or maintain the values of the currencies. But you know that two objectives here are conflict. Because if the governments they want to follow the high GDPs, and you know that if we want to get high GDP, we need to support one of the main factors support for that one, that we need more money in the economy. But you know that if more money out to the economies, the inflation rate will be increased. And it's reduced to the values of domestic currencies, reduce or dummy. So that's why we call here the trade-offs objectives. The trade-off objective. It means if the government they follow high GDP, they need to pay by the high inflation. And if the high inflation is mean, the high GDP is maybe the companies overheat it is mean the inflation rate is too high. The people or individual they spend a lot of money to buy an assets. So at that time, the value of domestic currency is reduced. Okay, so that's why in theories, we want to both of them separately or independently to make sure even we can have the increased GDP a little bit, but the value of domestic currency still remained. Okay, so that is a one point. And the central bank, they also have a role of managed currencies in or out of the banking systems. And they conduct money supplies. So that is referred to creative currencies. Or later we mentioned about the function of issuers, currency issuers. Currencies issuers here. And interest rate. Okay, and interest rate. And so in here I say, beside those key terms, and right in here, the central bank has been described as the lender of last resort, cứu cánh cho vay cuối cùng. You should know this key term. The lenders of last resort or last resort lenders, the same meanings. It means the central bank prevent the country's banking system from failing. So on video, you know, that's the commerce bank ones. They take deposits and lendings. They take money from, let's say, from one person's, okay, and then they make loans to the other ones. And so maybe the guys, they take this money and they deposit again to the other bank, the commerce bank too here. Again, so here the lending from bank one become the deposits of bank two. And so the bank two, they take deposit from this guy and they make loans again for the other ones. So the other one, they take money, they put in the bank threes, commerce bank threes. Okay, so here you can see the process. So the money create again and again for the whole banking systems. So this system works based on the words I mentioned before, the charts of participants of the depositor or the players of the financial system. So if one people or if one commerce bank, they lost the trust or they lost confidence of the participants, it's impacted on the whole system. So it leading to the risk we call the contagion risks. Contagion risks. And to avoid contagion risks, we need to have the central bank as the last resort lenders or the lender of the last resort. Let's say for client in here, they borrow money from bank three, but they cannot. They have a bad debt. It means the client, they borrow money and they fail in their project. So that's why they cannot have enough money to repay to the commerce bank three. And if not only one, but a lot of client bank threes or a lot of borrowers of bank three fail into repay money. So that's in that case or in that scenarios, commerce bank three, they have a high bad debt or non-performing loans. And at that time, maybe they need to support they need to borrow money from the central bank to have enough money to repay to the depositor or the savers. If not, I mean, if the bank three, they have not enough to repay, so they lost or they lose the confidence of the depositor or the participant in here, and this leading to the contagion risks. And so we understand the lenders of last resort is mean the central bank, they are the last person lending to the commerce bank in the way the bank or the commerce bank, they have no ways to get money, or they in the situation of bankruptcies or they have a liquidity distress, something like that. Okay, so why they do that? Because they want to prevent the country banking system from failing or from contagion risks or from default risks. The main functions of central bank here, we mentioned some main functions. The first one we call the currencies insurance. The currency insurance, that is the first and is also the most important roles of the central bank, and it makes the central bank totally different with the other institutions of economies. So when the central bank, they issue currencies, you know that from the government point of views, the government revenues or incomes is come from different sources. So the first one is come from the tax. Okay, the government impose tax on different parties, including individuals or on the firms with different type of tax. So that is the main revenues for the government. The other ones, the government, they can get monies, or I mean the cash flows of the governments, including tax. The other one, they can borrow money, or they can use debt. While they borrow money from the other foreign financial institutions, let's say they can borrow money from IMF or ADB or World Banks, or they can borrow from issuing bond or government bond, or in detail, maybe the government, they could be issue T-bill, T-notes, or T-bond to raise money. And one important here, that's referred to issue currencies. And this money could be support for the government's, for the macro objective for government spendings, spending for expenditures, or spending for investing. The other ones here. So when the government, they issues currency supporting for the economy or for supporting for the spending purpose here, you know, that's the outcomes maybe the GDP is up, but inflation rates may be up against. And so that's why we need to balance these ones. One of the balance is the central bank must be independent with the governments, as I have mentioned before. The second roles or the second functions here is the government bankers and the bank or the last resort lenders here. I just mentioned before. It means that the central bank, they are the last persons lending to the commercial bank in the way of bankruptcies, or in the way in the scenarios commercial bank have no ability to repay money to client. The central bank, they also manage the country foreign exchange and gold reserve. So that is belong to the nation's reserve. Okay. The central bank, they also regulate, observe, or supervise the banking industry to create the financial stabilities of financial system in order to obtain the final objective, that is create the confidence. And the last one, the central bank, it could be that is the instrument that the government they use to implement it, or to conduct monetary policies. So how they conduct monetary policy, I leave this topic later when we mention about, we have a specific topic about monetary policies. Okay, in here. Because when we mention about the policy instruments, actually, we have in the economy, we have two main instruments. One we call monetary policy, will be conducted by the central bank, and the other is a fiscal policy, will be conducted by Ministries of Finance. Okay, fiscal policy focus on the use of the government revenues. That is a collection I have mentioned, tax, borrowings, issuing monies, and expenditures, spending to impact to the economy in here. And so in this case, maybe the government, they can use some instrument, let's say the bond, issuing bond, or something like that. But that is belong to the revenue and spending of the governments. But on this side, the central bank, you know that they determine here the growth rate of money supplies. That finally impact on the interest rate. And so you know that the interest rate, that is a price of the capitals on the financial market. Okay, how much you should pay for the lenders, how much you should pay for the investor or the borrowers. We use the interest rates as the price. The monetary policy, including three main tools: open markets, discount rates, reserve requirement. I leave this one later when we have another topic about the monetary policies. But in general, three main tools here could be used by the government in order to conduct the final objectives, the inflation, or equivalent to the maintain the values of domestic currencies. of domestic currencies. So how the central bank they do these ones? How the central bank they use one of those tool to maintain the value of domestic currencies. Now let's say we look at these ones. Here is a balances of the central bank. You should know a little bit about the balances of the central bank. So one side here is assets of a central bank, including the foreign assets, loan to the government, loan to the bank or the commercial bank or to the other bank. And liabilities is mean how the central bank they gets monies. One is the notes or coins will be used by the central bank. The other is the deposit from the other government, from the bank reserves. This is the money they get from the commercial bank. The foreign loans is mean the central bank, they borrow money from the other central bank in the world. And the central bank security is mean the central bank, they issue bond or T-notes to raise monies. So when you look at these ones, you see the name. The name we mentioned here is the bank reserves. The bank reserves are, what does it mean? So here is the commerce bank. Let's say here the balances of the commerce bank here. On this side, I have a note. Okay, here is the balances of the commerce bank. So we also have asset side and the liabilities, or we call the capital, the liability here of commerce banks. So the liability is mean the commerce bank, they take money from deposits. Okay, deposit. They get money from deposit. Okay, and so the main liabilities come from the deposits. Of course, this the commerce bank they can raise money from their securities or from the other assets, but the main source of liability, that is the money come from the saver. They put money into the banks, and then the bank take money to make loans. So that is the lendings or loans to the economies. But let's say you know that maybe this let's say in here commerce bank they can raise $100 from depositors, but they cannot make loans totally $100. Let's say it depends on the bank reserves. Let's say if the bank reserve is a 10%, it means after receiving $100 from depositors, the commerce bank they lending $90 and $10 they put in the central banks as the bank reserve in here, $10 in here. Why they need to put $10? That is insurance. That is insurance instruments to make sure in the futures, whatever happens, the commerce bank, at least they have a money from bank reserve to repay to depositors. Because the loans for the client or for the borrowers in the futures, and future is uncertainty, so we cannot sure the bank can get back fully $90 or $100. So that's why in all countries, the central bank, they require commerce bank must leave a part of money in terms of bank reserves at the central bank. Now let's say if the central banks are they scaring about the riskies, the higher riskies of the banking system, so that's why they increase the bank reserves is to 20%. So it means that if the commerce bank they get to $100 from depositors, they just make loans about $80, and then they need to send or they need to deposit or they need to give $20 to the central bank as the bank reserves. Okay, so that's what we call about reserve requirements for the central bank reserves. In detail, in some countries, they also give a little bit different regulations on reserves. Let's say in US, you can see that's one, that is the regulation. It's been from 2014, almost the commerce bank, if they have a net transaction account less than 50.2 million US dollars, they have a no minimum reserves requirement. However, if they have deposit, if they take money deposit, they take deposit from client with a total money from 50.2 millions to 110.2 millions. So the liquidity ratio, or they need to leave 3% of deposits in terms of the bank reserves. And when the total deposits more than 110.2 millions, the reserves requirements about 10%. Okay, so it means that the reserves here, reserve requirement is not fixed numbers, it's flexible, depend on the amount of deposit that's the commerce bank they get from the clients in here. So that is a very flexible policy to encourage the commerce bank to put more money to the economy, or to support for economy. And in here, they said that the threshold money amounts recalculate annually. Okay, so it means even the central bank of US, they have a flexible reserve requirement. However, this also changes every year. And in the other country, let's say in Canada, UK, Australians, Sweden have a no reserve requirements. That is a very interesting point when you compare with the other central bank. So why they have a no reserves requirements? It means the commerce bank, they take money from depositors so they can make loans 100%. No more money are required to put in a reserve account. That is also very interesting. It means encourage the commerce bank, they can lending out all monies to the economy. The other contents refer to the central bank is mean the name of the central bank. Actually, in fact, there were no standards when they want to name of the central bank. Let's say for the country, let's say UK or Canada or Mexico, the name of the central bank is the Bank of England. It means the name of the countries, or the Bank of Canada, the Bank of Mexico, the Bank of China. So this is the central banks of those countries. But the other banks, they can take the name, let's say, a National Bank of Ukraine, or State Bank of Vietnam. That is a central bank, or Reserve Bank of Australia. And in some country like Singapore or Maldives, you see they have a name of central bank. It's very funny. Monetary authorities of Singapore, Maldives monetary authorities. Okay, so that's why we have no standards name for all central bank in the world. And so that's why be careful with the confusing name. That's the Bank of Americas. The Bank of America, that is a commerce bank, not central bank. Or Bank of India, so that is also the name of the commerce banks, not the central bank. So we back to the question I mentioned firstly. Should the central bank be independent from the government or not? Some countries they follow about they merge the central bank with the government, but the other one they make it totally independent. So to answer these questions, I require you look at the different case studies. So we have 5 groups. So group 1, you mentioned about the Fed, that is the central bank of US. Okay, group 2, you mentioned about the central banks of the central bank of England. Okay, we call the Bank of England. Bank of England. Good to see my writing, students. That is from the UK.
What does it mean?
Okay, I write the name and I raise a question later.
Okay, thank you.
Group 3, you talking about the European Central Bank. Group 4, you're talking about the Bank of Japan. And Good Fives, you're talking about State Bank of Vietnam. So we have a 5 groups. So that's why you mentioned the 5 central bank in the world. So what is the question you are required? So the firstly, just tell me how central bank in those countries established. How was central banks established? Or who are the members of the central bank? Okay, and the other ones, what is the role of central bank in those countries? Let's say when you mention about European central banks, you tell me what is the specific roles of the central banks. Or when you mention about the Bank of Japan, so you also mentioned about this one. Or even you mentioned about the State Bank of Vietnam, you tell me how it established and what is the role of the central bank in Vietnam or SPV. Okay, and the next question is, you answer the question is the central bank or should central bank? So central bank is be independent from the governments. Let's say when you mention about the Bank of England, so you answer the question is the Bank of England is independent from its government or not? Okay, so that are 3 main questions you focus to answer for me. Refer to different central bank in the world. Okay, we have 5 groups, so we have a 5 topic here. So again, 50 minutes for you to look at these ones. To answer the question, you go reading materials. On reading materials, we have a full information about this central bank, except the State Bank of Vietnam. Okay, and then you prepare in the papers, and after 50 minutes, no, I think 20 minutes for you. We share it together. Okay, so that is a case study for you to discuss today. Okay, students, are you clear on my question?
Yes.
All right. So go to reading materials, topic 3, 4, 5. Sorry, 4, 5. You got it? You got the material, refer to these questions.
Yes.